They are afraid. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, political elites face a terrifying dilemma that threatens a global catastrophe. And I want you to understand the urgency of what's going on here and why the political elites are so terrified. Because if this is not dealt with swiftly and quickly and in a peaceful way, it threatens to destabilize an entire region of the world and underpin at the same time several major economies that will send the world spiraling into a deep recession. And we have a sponsor for today's show, Celsius. They're on the New York Stock Exchange under the symbol CVM, and they're about to commercialize their cancer immunotherapy drug early this year. And you can get in before that happens because right now analysts are putting a price target on this stock of more than double its current trading price. Stay tuned to the end of the show or check out the pinned comment or description below for more information. Now let's head to Bloomberg, where he picked today's story up with a headline, as Iran urges diplomacy as U.S. weighs response to deadly attack. And as Iran is saying that diplomacy now is the only way forward. And noticeably, this is a shift from a country that chooses violence at every opportunity that suddenly they want to have a peaceful resolution. Is it because they're afraid of a retaliatory attack? Well, not really. There's something much bigger on the global economy scale that they're concerned about. The foreign minister of the Islamic Republic said active diplomacy is underway to find a political solution to the war in Gaza and the regional fallout. Well, of course, without elaborating, because they really don't have much of a story here. Again, you have a group of people that when faced with conflict, you can choose either peace or violence, and they choose violence more times than not. And this is an issue here because they don't have an answer. If they wanted one, there are many things they could do. They could stop supplying weapons to the militants. They could go in and say, hey, you know what? We're going to get these shipping lanes reopened. We're going to do everything we can to create a peaceful solution, to bring people to the table and find an answer. But the reality is that's not going to happen. And the White House knows very well that the way to end the war and the current crisis in the region is political. Well, if people could get together and talk out their problems, but maybe that would happen. But there's a reason they're so worried, because if it's just a matter of a retaliatory strike for what they did, and we'll talk about that in a moment, I don't think they're really afraid of that. There's something much deeper here, and there's an undercurrent in the global economy that's starting to shift. The problem is they see it, and they're more afraid of what it's going to bring. The comments came as the U.S. weighs how to retaliate against a deadly attack on a base in Jordan that killed 3 American soldiers and injured dozens. President Joe Biden blamed Tehran-backed militias in neighboring Syria and Iraq and said he'd respond, quote, at a time and in a manner of our choosing, suggesting that indeed something is coming. And here we can see on the map where the drone strike was. This is a huge problem because Hamas militants attacked Israel now on October 7th from Gaza, triggering the war and roiling the wider region. And since then, U.S. bases in Iraq and Syria have come under regular fire from Iran-supported groups, again suggesting that if they wanted a peaceful resolution, well, one thing they could do would be stop attacking our bases. That would say a big sign to the White House that we do indeed want a resolution here. But suddenly they need peace, and there's a reason why. Again, we'll talk about these undercurrents that are shifting here in a moment. And Hezbollah, also backed by Iran, is exchanging fire with Israeli forces almost daily across the Israel-Lebanon border, suggesting that there's no sign of a de-escalation here coming at all. And if they wanted peace, they could do steps and say on a global stage, look, we're doing what we can, we're making an effort here, somebody come meet us halfway. But it's an issue because if this global economy does not start to change, the undercurrent that's going on here is these are afraid, the people in Iran, that their own people, instead of looking outward at conflict, they're going to turn inward. Because when an economy slows down, in this case, we're looking at the entire world, people stop focusing on what's going on outside of their borders. They start focusing internally. And that means the people in power tend to go. This is an incredibly volatile time in the Middle East, according to U.S. Secretary of State Antony Blinken. I would argue that we're not seeing a situation as dangerous as the one we're facing now across the region since at least 1973. Now, this is a challenge again for the Biden administration, who says, you know what, we need to respond here, but do we escalate this? Do we make this even worse at a time when the domestic economy is slowing? More people are on unemployment, about 1.833 million, and that number is likely to go up with some of the news we're seeing today, suggesting we have problems at home. And that is a problem for not only the president, but of course, you think about global leaders around the world that are in power. If our economy starts to go and demand around the world starts to go, people start looking inward to solve their problems. And that means those in power in Iran may not be there much longer. And we've made very clear from day one that we're going to defend our people, we're going to defend our personnel, and we're going to defend our interests, he said. At the same time, the president's very clear that we want to prevent broader escalation. The question is, how do you achieve this before the global economy goes? Because that should be the objective here of Iran. As you're about to see, they know what's coming. And if they could get to a peaceful resolution, maybe they could keep and help keep the global economy running, because what fuels their economy is oil. And oil dips now as markets weigh Middle East tensions against demand. Now remember, we've heard not long ago the case that war and other issues were going to drive crude oil prices to 100 a barrel, 150, and then even maybe 200 plus. And of course, all that money continues to fuel these countries like Iran. The problem now that happens is if you see demand and prices go, well, what happens to their domestic economy is it falls apart. And suddenly they can't support the people that they have out fighting the battles for them. And next thing you know, people turn inward and start to take people out at the top. And traders are clearly worried about the conflict spreading the impact of the flow of oil, but that has not so far happened. That's what everyone expected. And with China growth worries a concern as well, these attempted rallies seem to be short-lived. And that is the issue here, is the global economy is slowing. Demand is slowing. Cost of oil, price of oil is going down. And that alone leads to the destabilization of these countries in itself. And of course, if people can't provide for themselves, if the economy in countries like Iran cannot sustain itself, again, people turn inward and start to take out the political leaders and put new people in. And that's no different than our economy as well. You know, we talk about presidents that are facing a second term. If there's a recession, the probability they get reelected is somewhere close to zero. It all happens just in different ways. And we can see the effects on crude oil here, because if you look at our economy in terms of real gross domestic product against West Texas Intermediate, that's shown in red, where oil goes on a year-over-year rate of change, what happens is the economy follows it. So we see periods where oil prices are coming down. That means demand and energy demand is coming down, and that means the economy comes down, and then crude oil prices start to go up, and what happens? The economy rebounds. And right now, everybody's celebrating that big fourth quarter here in the U.S., and oil is saying, look, the economy is about to turn down again, and now let's head over to Texas, because we're starting to see internally here, problems are getting much worse. It's stagflation, border failure, and regulatory dysfunction. This from the Texas Manufacturing Survey that collapsed in January. The soft data slaughterfest continues. This from Zero Hedge, which is a huge miss for the Dallas Fed's Manufacturing Outlook Survey, plunging from minus 9.3, that's a contraction, to minus 27.4, biggest miss since the COVID lockdowns, as many expected it would not be that bad. And the production index, a key measure of state manufacturing conditions, dropped 17 points to minus 15.4, the lowest reading since mid-2020, suggesting that the state of Texas now, the manufacturing sector, is mired in contraction. Now, of course, we know that there are knock-on effects from this, that you don't just get a slowdown without some other issues coming up. We'll talk about those in a minute. Let's look at some more of the data, because other measures of manufacturing activity also indicated a contraction this month. New orders, and we talk about how critical new orders are to manufacturers, because when you have a backlog and you have a bunch of workers and you don't have a lot of new order flow coming in, you can work through your backlogs. But when your backlogs are running low, you need a lot of new orders to keep your employment ranks strong. If you don't have both, well, you have to let people go. And new orders ticked down from -10 to -12.5 in January, while the growth rate of orders index remained negative, but pushed up 8 points to -14.4. Still in contraction, capacity utilization index dropped to a multi-year low. That means inflation coming down in Texas, and shipments index slipped 11 points to -16.6. Perceptions of broader business conditions continue to worsen in January. And additionally, wage and input costs continue to increase this month. So if people think, as an employer, that conditions are getting worse and that they have to pay people more money and they just don't have the work for them, well, that starts to change exactly everything about the U.S. economy that nobody said could happen. But let's take a look at the effect of crude oil prices in Texas. And sure enough, there is a strong relationship between the manufacturing sector and West Texas Intermediate. We see WTI in red against the current new orders book for Texas. And what do we see? It is in contraction. It's been in contraction, that blue line. And what is it suggesting? That it follows crude oil prices lower. So if crude oil prices continue to fall, well, it tells us that manufacturers in Texas will have one choice to make. And it won't be when they want to. The problem is, as more manufacturers start making this decision, the U.S. economy is the next to go. And sure enough, we can see a relationship between continued unemployment claims in blue against West Texas Intermediate shown in red. And what we know is that periods where crude oil prices come down as a sign that demand is falling, well, it usually indicates unemployment go up and people stay on unemployment longer. You see it here again in the dot-com bubble. You see it during the global financial crisis. You're seeing all signs of it now. As crude oil prices come down, more and more people are on the unemployment line, suggesting that this continued claims number that everyone is hoping is going to go down is likely to go up, because here we're seeing demand, which suggests that coming out of Texas in the future, we should see higher unemployment claims. And one major employer today said, well, we're laying off a bunch of managers. As UPS to cut 12,000 jobs and bring workers back in 5 days a week. Of course, we know a lot of people working from home will not like that, as job reductions about 14%. That's huge. Of 85,000 full and part-time managers will save $1 billion this year and more subsequent years. This was Tomei on an earnings conference call on Tuesday. She said the company planned to ask workers to return to office 5 days a week in 2024. And so what happens when demand comes down? Companies need to maintain their profit margins. They need to maintain their stock prices. They need to do things. And when they can't cut anything else, they start to cut heads. That is where we're at now. I mentioned this would come and happen. We'd get these periods of high inflation. People would go and want and demand, and rightfully so, wage increases. The problem is, if the economy wasn't strong enough to handle those wage increases, and it wasn't, then what would ultimately turn into is a bunch of job losses, and now they're here. After registering a 9.3% drop in annual sales, there goes demand from the U.S. economy. UPS forecasts a 2024 upswing as little as 1.1%, suggesting that any sort of soft landing here isn't going to materialize. In fact, soft demand in Europe and the U.S. led to an overall decline of 7.5% in fourth quarter delivery volumes. So you want to think about where the economy is going. One of the great places to look are companies like FedEx and UPS, because if they're not shipping stuff, it means there's not demand. And if they're shipping more, well, it's very clear there's demand there. In this case, higher labor costs and lower package demand resulted in fourth quarter sales and 2024 guidance that missed expectations. And UPS is seeking alternative strategies for its truck brokerage business, which has seen sales plummet amid a freight recession marked by declining rates and overcapacity. And again, it all comes back to one key thing: a lack of demand. And that is a problem for not just the U.S. economy. It's not for Iran. It's the entire global economy. So you start to understand here, if the U.S. slows down, and part of the reason why is prices go up because goods are not flowing through the Red Sea, Iran could step in here and do something to help make that be a solution to the problem instead of making it worse. Well, maybe the U.S. economy would be in better shape and there would be more demand, and that would put support under oil prices. Because of the conflict that's going on there, if this escalates, look for things to get much worse. And one of those, as we're starting to mention, is the U.S. labor market. And today we got the U.S. job openings and labor turnover survey, which says openings rose to the 3-month high, but here's an issue. Fewer workers quit. And you start to think about, why do people quit their job? Well, they quit to get a higher wage. And if they think that that new job is better, is going to pay more, they'll make the move. The reason they don't isn't because there may not be a job out there that's paying more. It's because they think they'll be the first to get laid off when demand goes down. As vacancies increased to 9 million from an upwardly revised 8.9 million reading the prior month, this is according to the Bureau of Labor Statistics. The December figure exceeded all estimates. And at the same time, the number of people who voluntarily quit their job fell to 3.4 million, the lowest in nearly 3 years. And so that tells you that workers are not confident about the economy. They would love to switch to make more money, but they're afraid. They don't believe either that there's jobs out there that are real, or that if they took the job and things slow down, that they would keep it. And the metric has been largely declining in recent months, which may imply Americans are feeling less confident in their ability to find other jobs in the current market, or to get new jobs that are better paid, or that they keep the job after they got it. And of course, there is a strong relationship between the equity market and the JOLT survey, as we've shown before. And the last time it diverged, we saw the Wilshire 5000 price index rally as the JOLT survey went down. We were headed into recession before the pandemic, so we'll never know what actually would have happened if the pandemic never occurred. But look, now everybody's bullish on stocks, everybody's chasing stocks higher, and the job openings and labor turnover survey is still trending down, suggesting, as we continue to make the case, that the U.S. economy here is indeed slowing. And that all again comes back to the labor market, because if job openings are not increasing, well, it tells you what employers are doing. It means they're sending people home, they're laying them off and not posting them for a new job, which is why there's a near mirror relationship between the job openings and labor turnover survey in blue and continued claims here in red, suggesting that the only recent increase in the JOLTS openings was because continued claims ticked down a little bit. But remember, that was on a seasonally adjusted basis. Well, of course, we'll have new data on that Thursday, as well as more oil inventory data tonight with the API, and tomorrow with the Department of Energy. As the report underscores what's been a gradually moderating labor market, and the trend has been choppy along the way. And while the pickup in openings underscores a solid labor market that has kept the economy out of recession, the declining number of quits shows workers are increasingly clinging to the jobs, suggesting that the U.S. economy is nowhere near as good as you think it is, or at least these political elites. And that's why you're starting to see them get worried here, why they are afraid, because they've got a region of the world that's destabilizing, oil prices are falling, it's looking could be even more political chaos there, and at the same time at home and in other major economies, demand is shrinking, more people are starting to lose their job, suggesting that things for the global economy this year are going to get much worse. But one thing that is getting better, well, that is demand for our sponsor today, Celsius. Their stock price looking to break out here as more and more people are starting to realize that they've got an answer to a cancer problem. And that means, of course, as we'll show you, analysts got a price target on this stock of more than 100% gain from where it is now. I'll show you the first 25% move, but let's take a look at who this company is. You find all the information on them in the comment and description below, and you find them on the New York Stock Exchange under the symbol CVM, because they're dedicated to research and development directed at improving the treatment of cancer, autoimmune, and infectious diseases. They're a pioneer in cancer immunotherapy. Let's take a look here. Their phase 3 trial is the largest ever in head and neck cancer, with 928 patients enrolled. The top line data read out in June of 2021 showed that when the multi-keen treatment regimen was given after diagnosis, before surgery and radiation, that it produced very significant 5-year overall survival benefits, 62.7 versus 48.6, and get this, with no toxicity added to the treatment. And other treatment arm, the administration of chemotherapy along with radiation, negated the survival benefit from multi-keen, suggesting that they do indeed have an answer here for head and neck cancer. This is a big issue because a lot of people are getting older. They're going to get cancer, look for answers. And of course, they're going to be looking to Celsius on the New York Stock Exchange under CVM, and making a major milestone toward regulatory approval. The UK's National Institute for Health and Care Excellence selected multi-keen to be evaluated as a potential new standard for care of squamous cell carcinoma of the head and neck. And that is fantastic news. They've also expect to submit the target population data to the U.S. Food and Drug Administration and Health Canada early this first quarter of this year. And of course, this would be required for consideration to get them approved and could lead to commercialization as early 2024, giving you the advanced knowledge of what's going on here as this company moves forward to get it in on their stock early. And of course, this is why we see analysts has a price target on this at $8.47. Remember, when I was a kid, you used to hear the commercials when E.F. Hutton talks. Well, E.F. Hutton is talking. They're saying buy, of course, Celsius on the New York Stock Exchange under CVM because they think it's going higher. Let's take a look at the stock here, because if they do get commercialization and it works the way they say they are, there's going to be huge demand for this drug, and that's going to send their stock price higher. The fact to the point, when we look at over the last 2 years, we can note the 2-year volume profile right down the middle here. What we can see is there's been a lot of buying lately as people know where this company's stock price could go as soon as they get to commercialization. Let's zoom in here a bit, because we both note that on a technical basis, the MACD is breaking out to the upside, the RSI in positive territory and rising. It's got momentum behind it, and here we can see on the 90-day chart, stock price comes into the supply zone. Buyers are showing up because why? They know if this thing goes commercialization, that means they're going to sell, they're going to make money, and the stock price is going to go up. Remember, it's the early move in companies like Celsius that you want to get behind. And what happened? Stock price rallied up. Sellers came into the supply zone above. They pulled back. Buyers step in, and now they're looking to break out of this upward supply zone. That would be a 25% move if we get to this upward zone here. And I think that's very achievable, because looking at the 30-day volume profile, look at where buyers are at. They're right underneath current price, and that tells you some big buyers are coming in and pushing the stock price higher and higher, and you too can be a part of the Celsius story. Again, they're on the New York Stock Exchange under the symbol CVM, and as always with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.